So there's a concept called time in the market versus trying to time the market. And this chart shows the value of 10K invested into the S&P from January 2003 to December 2022, which is a 19-year time frame. So if you stayed in it all of the days, your 10K will be worth 64.8K. If you miss just the 10 best days in 19 years, your performance is more than cut in half. 19 years. Then if you miss the 20 best days, your performance is cut almost in half again. You only made 7.8K. If you missed the 30 best days or more, you only made $1,700. And if you missed the 40 best days, remember, this is just a little over a month. In 19 years, you start to lose money. Now, when it comes to providing liquidity in DeFi, it's the same thing. So if I pull up Zora, and I think Zora should be our test example. We're gonna do like a case study. So if we look at Zora, and I want to look at, when you're providing liquidity, you want to look at the Zora USDC chart. This is USDC. So, it's kind of consolidating right now, but obviously with the bull market, I definitely think Zora is going to pump as well. And I think ETH is going to pump as well. So, but Zora will probably outperform ETH at this point. The market cap is only 297 million. In a project like this, I can see it going to a few billion. This is Coinbase's base chain's first bull market. People don't understand how huge that is. So now we want to look at Zora, the Zora ETH chart, right? So now going back to time in the market versus trying to time the market. If you look at this, you can see that there were a few volume candles that really stood out. You had this one and you had this one, and that's this big candle here. And then that's this candle here. Now, you never know which days are going to be the best days. So just because the APR isn't like extremely high right now, just like in the pool that I showed you in the presentation, there's going to come a day where there's going to be a huge green candle or red candle, a big volume spike. And you want to make sure you're in range for that day, because just like if you miss the best days buying and selling in the S&P, if you miss the best days when providing liquidity, it's going to have a drastic impact on your performance. So how I like to think about when I'm providing liquidity is, I want to look at the current yield, but I also want to think in my mind, like, is this something that's going to be accumulated heavily in the future? If the answer is yes, I want to set a range that will allow me to maximize the short-term yields, right? So maybe something like this. And then I also want to set a range to where, like, once those big candles happen, I want to be in range, because it's like, I always compare this to selling shovels during a gold rush, right? If you know it's going to be accumulated like a lot, then you want the people who sold shovels, they made more than the people who were, mining the gold. Everyone didn't find gold. Everyone's going to be coming and buying Zora. Some people aren't going to take profits. Like, some people are going to make good money from it, but some aren't. But if you're just accumulating fees off of all those other people buying, then it's guaranteed. And, usually you don't like to use the word guaranteed, but it's guaranteed that you're going to make money, because you're making money from swap fees. Like, it's a real yield.